Good afternoon, and today we will be talking about revenues and other receipts. So revenue is the gross inflow of economic benefits or service potential during the reporting period when those inflows result in an increase in equity, other than increases relating to contributions from owners. It includes only those that are received or receivable by the entity in its own account. Receipts refer to actual cash collections from all sources during a period. So the fundamental principles for revenue are A. All revenues of an entity shall be remitted to the national treasury and included in the general fund of the national government, unless another law specifically allows otherwise. B. All monies and property received by a public officer acting in any capacity or upon any occasion shall be accounted for as government funds and government property, unless another law specifically states otherwise. C. Amounts received in trust and from business-type activities of the government may be separately recorded and dispersed in accordance with relevant rules. D. Receipts shall be recorded as revenue of special, fiduciary, or trust funds, or funds other than the general fund only when authorized by law. E. A collecting officer shall immediately issue an official receipt, or OR, upon collecting a payment of any nature. F. Where mechanical devices, for example electronic official receipt, are used to acknowledge cash receipts, the COA may approve upon request the exemption from the use of accountable forms. And G. Temporary receipts shall never be used to acknowledge the receipt of public funds. H. Pre-numbered official receipts shall be issued in strict numerical sequence. Duplicate copies shall be the exact copies of the original. I. A collecting official shall accept payments to the government in the form of checks, upon proper endorsement and identification of the payee or endorsee. The collecting officer shall not use government funds to encash private checks. J. Receipts of government funds shall be acknowledged in accordance with the law, indicating the date of receipt, from whom and on what account the fund. So the type of funds are: first, general fund, a fund which is available for any purposes other than those which other funds have been designated to. Second is special fund, which is designated for special purposes. Next is trust or fiduciary fund, which is held by a government agency or public officer acting as trustee, agent, or administrator for the fulfillment of a condition. Next is revenue fund, comprises all funds derived from the income of any government agency and available for appropriation or expenditure in accordance with the law. Next is depository fund, which is held in an authorized depository bank over which the recipient agency retains control for the lawful purposes for which the fund was received. Next is special account in a general fund, or SAGF, established to facilitate the funding of priority activities of the government. They are sourced from specific fees, grants, and donations, and other sources identified under the law. The following are relevant legal provisions regarding the SAGF. A. All income collections for special and fiduciary funds shall be remitted to the Treasury and treated as SAGF. B. They shall be considered as being automatically appropriated for purposes authorized by law, except when the General Appropriations Act, or GAA, provides otherwise. C. They shall be released to government agencies subject to the approval of the President. Last is special purpose funds, or SPFs. They are those that the President allocates for special programs and projects. Unlike for other funds, SPFs are not under the accountability of any particular government agency or office or unit. The two sources of revenue are: A. Exchange transactions or reciprocal transfers, in which one entity receives assets or services or has liabilities extinguished and directly gives approximately equal value to another entity in exchange. Sales of goods and rendering of services. B. Non-exchange transactions or non-reciprocal transfers, in which an entity either receives value from another entity without directly giving approximately equal value in exchange, or gives value to another entity without directly receiving approximately equal value in exchange. Next are equal exchange transactions. First is sale of goods or provisions of services to third parties or other government entities, under which is A. Service income, which includes permit fees, registration fees, franchising fees, licensing fees, legal fees, passport and visa fees, processing fees, and the like. Next is business income, school fees, examination fees, rent lease income, communication network fee, income from hostels or dormitories, sales revenue, hospital fees, sharing the profit of joint venture, and the like. Second is use by other entity of assets yielding interest, royalties, and dividends or similar distributions, under which is first interest income, charges for the use of cash or cash equivalents or amounts due to the entity. B is royalties, fees paid for the use of the entity's assets such as trademarks, patents, software and copyrights, and dividends. Share of the national government from the earnings of its capital or equity investments in government-owned or controlled corporations or GOCCs and other entities. Next is the recognition of revenue or from exchange transactions. First is sale of goods, in which first significant risk and rewards of ownership of the goods are transferred to the buyer. Second is the entity does not retain continuing managerial involvement or effective control over the goods sold. Third, it is probable that economic benefits will flow to the entity. Fourth, revenue shall be measured reliably. And fifth, costs relating to the transaction can be measured reliably. Next is rendering of services. Revenue from the supply of services is recognized on a straight line basis over the period of the services are rendered. However, revenue is recognized by reference to the stage of completion, in effect, percentage of completion method, if the outcome of the transaction can be estimated reliably, such as when all of the following conditions are satisfied. First is the stage of completion of the transaction at the reporting date can be measured reliably. Second, it is probable that economic benefits will flow to the entity. Third, revenue can be measured reliably. And fourth, costs relating to the transaction can be measured reliably. When the outcome of the transaction involving the rendering of services cannot be estimated reliably, revenue is recognized only to the extent of the expenses recognized that are recoverable. Next is our interest, royalties, and dividends. Interest is recognized on a time proportion basis that takes into account the effective yield on the asset. Second, royalties are recognized as they are earned in accordance with the substance of the relevant agreement. And third, dividends are recognized when the entity's right to receive payment is established. Next is measurement of revenue from exchange transactions. Revenue from exchange transactions are measured at the fair value of the consideration received or receivable. Any trade discounts and volume rebates shall be taken into account. When cash flows are deferred, the fair value of the consideration may be less than its nominal amount. In this case, the fair amount of the consideration receivable is determined by discounting all future cash flows using an imputed rate of interest. Exchanges of goods or services. First is A. Similar nature and value do not give rise to revenue. B. Dissimilar nature and value give rise to revenue measured using the following order of priority. First is fair value of the goods or services received, adjusted by the amount of any cash transferred. Second, fair value of the goods or services given up, adjusted by the amount of any cash transferred. Next is rendering of services. Revenue from the supply of services is recognized on a straight line basis over the period of the services are rendered. However, revenue is recognized by reference to the stage of completion, in effect, percentage of completion method, if the outcome of the transaction can be estimated reliably, such as when all of the following conditions are satisfied. Next is recognition of revenue from non-exchange transactions. First is tax revenue, recognized as a gross amount and not included for expenses paid to the tax system, and shall not be grossed up for the amount of tax expenditures. Next is transfers. Inflows of future economic benefits or service potential form non-exchange transactions other than taxes, and include fines, gifts, donations and goods and services in kind, debt forgiveness, bequests, and grants. All of these transactions transferred resources without approximate equal value in exchange, and are not taxes, but some are with conditions. Next are fines and penalties, which are recognized as income in the year they are collected. They are, however, recognized as revenue when the receivable meets the recognition criteria for asset, and are measured at the best estimate of inflow of resources to the entity. An entity collecting fines in the capacity of an agent shall not treat those fines as revenue. Next are gifts, donations, and goods in kind, which are recognized as revenue when it is probable that future economic benefits or service potential will flow to the entity. Those that are received without conditions are recognized immediately as revenue. Those with conditions are initially recognized as liability and recognized as revenue only when the conditions are satisfied. Next is services in kind, which are not recognized as revenue due to their uncertainties affecting the entity's ability to control those services and measure them at fair value. Next is measurement, under which are A. Assets at the acquisition date fair value. Next is liabilities at present value when the effect of time value of money is material. And third is revenue, at the amount of increase in net assets. If the non-exchange transaction is initially recognized as liability, the subsequent reduction in that liability, in effect, because the condition is satisfied, is recognized as revenue. Next is debt forgiveness. When a lender cancels the debt of a government entity, the debtor recognizes revenue equal to the carrying amount of the debt forgiven. However, when a controlling entity cancels the debt of a wholly owned controlled entity, the cancelled debt is treated as contribution from owners and not revenue. So the fundamental principles for revenue are A. All revenues of an entity shall be remitted to the national treasury and included in the general fund of the national government, unless another law specifically allows otherwise. Next is grant with condition. Asset received under a grant with condition is initially recognized as liability and recognized as revenue only when the condition is satisfied. Next is rendering of services. Revenue from the supply of services is recognized on a straight line basis over the period of the services are rendered. However, revenue is recognized by reference to the stage of completion, in effect, percentage of completion method, if the outcome of the transaction can be estimated reliably, such as when all of the following conditions are satisfied. Next are concessionary loans. Loans received by an entity at below market terms. The entity considers whether the difference between the transaction price or loan proceeds and the fair value of the loan on initial recognition is a non-exchange transaction. If it is so, the difference is recognized as revenue, except if a present obligation exists, in which case the difference is recognized as a liability and recognized as revenue only when the obligation is satisfied. Next are impairment losses and allowance for impairment losses. When an amount already recognized as revenue becomes uncollectible, it is recognized as expense or impairment loss rather than as an adjustment to the revenue originally recognized. Entities shall elevate the collectability of accounts receivable on an ongoing basis based on historical bad debts, customer or recipient creditworthiness, current economic trends, and changes in payment activity. An allowance is provided for known and estimated bad debts. Other receipts include A. Receipt of subsidy from the national government or disbursement authority. B. Receipt of subsidy or assistance from other government agencies, including LGUs and GOZCs. Third is receipt of excess cash advance granted to officers and employees. Fourth is receipt or refund of overpayment of expenses. Fifth is receipt of performance bond or security deposit. Sixth are collections made on behalf of another entity. And seventh are interagency and interagency fund transfers.